Hey friends, today we're diving into the exciting world of S-REITs and their recent rally. Most investors think REITs are just boring dividend plays, but I've got some eye-opening insights about why they're making waves right now as Fed rate cut expectations rise. The numbers don't lie. Some REITs are up over 2% while banks are taking a hit. I'll break down exactly what's happening, which REITs are winning, and what this means for your portfolio. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 700 videos with more than 300,000 watch hours as of December 2024. I also focus on regional and world economy topics. Let's start with something that might surprise you. S-REITs are making a comeback. For the second week in a row, Singapore real estate investment trusts have been climbing higher. Why? Global markets are betting on an extra 75 basis points of interest rate cuts from the Federal Reserve in 2025. This is huge news for REITs, which are typically very sensitive to interest rate changes. Think about it like this. When interest rates drop, REITs become more attractive for two main reasons. First, their borrowing costs go down, which means more money flows to the bottom line. Second, in a lower interest rate environment, their dividend yields look much more appealing compared to bonds or fixed deposits. It's like suddenly noticing that the neighborhood coffee shop has better prices than the fancy chain store. Over the past 5 trading sessions, the 7 REITs in the Straits Times Index gained an average of 5.2%. That's not just a small bump, it's a significant move. And it's backed by real money. Institutional investors poured in about $50 million in net inflows. That's equivalent to 0.1% of their combined market value. Have you ever wondered which REITs the big players are betting on? I've got the answer for you. The clear winners in this rally are the larger REITs. Capitaland, Integrated Commercial Trust, and Frasers. Centrepoint Trust attracted the lion's share of institutional money. CICT saw inflows worth 0.3% of its market cap, while FCT recorded 0.4%. These aren't random numbers, they show a clear preference from the smart money. But here's where it gets really interesting. While REITs are rallying, the 3 big banks in the STI, DBS, OCBC, and UOB, fell by an average of 3.4% during the same period. And institutions pulled out a massive $490 million from these banks. That's about 0.2% of their combined market cap. Why this dramatic shift? Think of it as a seesaw. When interest rates are expected to fall, banks often see pressure on their net interest margins, while REITs benefit from lower financing costs. It's a perfect example of how different sectors can move in opposite directions based on the same economic catalyst. But wait, is this rally happening across all REITs? Not exactly, and this is crucial to understand if you're thinking about jumping in. Here's something you might not realize about the current REIT rally. Size really matters right now. The broader S-REIT sector, which includes 39 REITs and property trusts, has actually declined by an average of 1.2% since February 19th. Surprised, I was too when I first saw this data. The key insight is that larger REITs are significantly outperforming their smaller counterparts. The 10 largest S-REITs by market cap delivered an average total return of 4.8% from February 19th to March 17th. More recently, they posted a 4.6% average return over the 5 sessions through March 17th, backed by $58 million in institutional inflows. It's like watching a race where the bigger, stronger runners are pulling ahead while the smaller ones are struggling to keep pace. The smaller S-REITs collectively fell by 3.3% since February 19th. They did manage a small gain of 1.1% over the past 5 sessions, but with much smaller institutional support, just $2.7 million in inflows. Why are larger REITs outperforming? It comes down to a few factors: better liquidity, stronger balance sheets, and more diversified portfolios. In uncertain times, investors often prefer these qualities. Think of it like choosing a big, stable ship during stormy weather, rather than a smaller boat. Are you holding any REITs in your portfolio right now? If so, you might want to check their size and sector exposure after watching this video. Let's zoom in on some specific standouts in this rally. MapleTree Logistics Trust jumped 2.3% in a single morning session on March 20th. Frasers Logistics and Commercial Trust also saw impressive gains, up 2.2%. What makes these logistics and commercial REITs particularly attractive right now? They benefit from structural trends like e-commerce growth and the need for modern commercial spaces. Plus, many of these trusts have properties across multiple countries, providing geographical diversification. It's like having rental properties, not just in one neighborhood, but across several cities or even countries. If one area faces challenges, the others can help maintain overall performance. So what should you do with all this information? First, understand that this REIT rally is closely tied to interest rate expectations. If those expectations change, for example, if inflation proves more stubborn than anticipated, the rally could lose steam. Second, consider the quality and size factor. The data clearly shows larger REITs are attracting more institutional money and outperforming. If you're looking at REITs, focusing on the larger, more established names might be a safer approach in the current environment. Third, remember that sector rotation is normal in markets. The money flowing out of banks and into REITs represents a classic sector rotation based on changing economic expectations. Being aware of these shifts can help you position your portfolio accordingly. Think of your investment portfolio like a garden. Sometimes you need to prune certain plants, like banks in this case, and give more water and attention to others, like REITs, based on the changing seasons. Right now, the season seems to favor REITs, particularly the larger ones. Have you noticed how quickly market sentiment can shift? Just a few months ago, many were avoiding REITs due to rising interest rates. Now they're back in favor. This highlights the importance of not making extreme portfolio decisions based on temporary conditions. What might the future hold for S-REITs? If the Federal Reserve does indeed cut rates as the market expects, we could see continued strength in the REIT sector. However, it's important to remember that REITs are ultimately backed by real estate, so the underlying property market fundamentals still matter tremendously. For Singapore specifically, the commercial and industrial property sectors have shown resilience, which bodes well for REITs focused in these areas. Retail REITs may face more mixed prospects as shopping habits continue to evolve in the post-pandemic world. Remember that while interest rates are important, they're just one factor. The quality of a REIT's property portfolio, its debt levels, occupancy rates, and management team are all crucial considerations for long-term performance. To sum up what we've covered today, S-REITs are rallying as markets price in more Fed rate cuts, with larger REITs outperforming smaller ones. Institutional money is flowing into REITs and out of banks, signaling a sector rotation based on interest rate expectations. Standout performers include logistics and commercial REITs like MapleTree Logistics Trust and Frasers Logistics and Commercial Trusts. The key takeaway? Interest rate expectations are driving market movements, but size and quality still matter tremendously when it comes to REIT performance. Now you're equipped with a better understanding of what's happening in the S-REIT market and why certain trusts are outperforming others. This knowledge puts you ahead of many retail investors who might just be chasing headlines without understanding the underlying dynamics. What's your take on REITs right now? Are you adding them to your portfolio or waiting for a better entry point? Drop your thoughts in the comments below. I love hearing your perspectives and questions. If you found this analysis helpful, check out my video on S-REITs benefit as recession fears rise, where I dive deeper into the metrics that really matter for long-term REIT performance. Until next time, this is Iggy from the Investing Iguana, helping you navigate the financial jungle one video at a time.